What's up? Today we'll be taking a look at some of the best low-cost dividend ETFs on the market. First, we'll discuss the pros and cons of dividend investing. At about the 5.5-minute mark, we'll start the ETF breakdown. For each ETF, we will look at exposure strategy, of course, dividend yield, portfolio composition, top holdings, cost, past performance, and analyst ratings. At the end, I'll give my own opinion. If at any point you decide you like this video, feel free to hit the like button, because that's what it's there for. Also, feel free to lurk below and check out the links in the description. You can get free stocks, free crypto, and other fun stuff. Without further ado, let's get started. A dividend is the distribution of some of a company's earnings to its shareholders. Dividends can be paid monthly, quarterly, or annually, although most are paid quarterly. Going back to 1970, 84% of the total return of the S&P 500 can be attributed to reinvested dividends and the power of compounding. This gives you an idea of how important dividends can be, and more specifically, reinvested dividends. The perk of owning dividend stocks is that even if the market trades sideways for a while and stock prices remain stagnant, you are still getting paid. While growth stocks tend to be very sexy in a bull market, they tend to trade with lofty valuations due to future growth being priced in, and thus can tend to get hit harder when a bear market comes around. The dividend stocks, however, tend to hold up better in a bear market. However, dividend payouts are no guarantee. Companies sometimes have to cut their dividends during hard times, but companies aim to have long-standing track records of consistent dividend payouts to maintain investor trust. Larger, more established companies with more predictable profits are typically the best dividend payers. These are often boring companies, but sometimes boring investing is the best investing. Investing in these long-standing, well-established, blue-chip, dividend-paying stocks is typically seen as a relatively safe form of investing. A high-value dividend can indicate that the company is doing well and has generated good profits. However, there is such a thing as too much of a good thing. Dividends do come at a cost. We must remember that many growing companies choose to not pay a dividend because they are continually reinvesting back into the growth of the business. As a result, investors can be rewarded with capital appreciation as the company grows its operations. So money being paid to shareholders is not being reinvested back into the business. Also, a dividend that is too high can indicate that management prefers to not reinvest back into the company because of lack of upside. In general, a dividend over 5 to 6% can be a flashing red flag of a potentially dying business. It might be tempting to take that bait of a high dividend, but it doesn't do you much good if it's a terrible business with a stock price that goes on to decline over the next few years. This is called a dividend trap. Dividends that are consolation prizes to investors for a lack of growth are almost always bad ideas, so it's important to pick high-quality dividend-paying companies and not just to invest in the ones that pay the highest dividend. So the good things with dividend stocks is that you don't have to sell stocks to get cash. The bad thing is that it can be tempting to take that cash instead of reinvesting it and taking advantage of the compound interest. Some call it the dividend snowball effect. You get dividends, then you reinvest them to go make more dividends, and then those dividends go on to make you more dividends, and so on and so forth until you're rich and you have 15 Lamborghinis in your garage. So keep in mind that choosing to take your dividends to live off today greatly reduces your future upside potential. This is the heart of deferred gratification, where you sacrifice having that money today so that it can make you more money in the future. A single share of Coca-Cola bought for $40 in the 1919 IPO with dividends reinvested is now worth $9.8 million versus the $341,000 that it would be worth without dividends reinvested. This is a prime example of how important it is to stay invested. DRIP stands for Dividend Reinvestment Plan. Investors can check with their brokerage to see if they can automate this. Automating investment is great because it makes you consistent and takes the emotion out of investing. You can set it up so that money automatically goes from your checking account to your brokerage every month to be automatically invested. It's such a powerful way to passively generate wealth over the long term without even having to lift a finger. Dividend haters will be quick to point out that dividend investing tends to be less tax efficient than growth investing. This is true. If no dividends are distributed, the investor gets to decide when to pay the taxes on the share of the company's earnings. The investor can declare their own dividend at any time they would like just by selling some shares, but they can also defer their taxes by simply not selling their shares. But dividend payouts are essentially a forced distribution, which is a taxable event. The dividend income is either taxed as a qualified dividend or an ordinary one. A qualified dividend is more attractive because it's taxed at a lower rate. For it to be a qualified dividend, it has to be issued by a U.S. company or a foreign one that trades on a major U.S. exchange, and you have to have owned the shares for more than 60 days. REITs are ordinary dividends, but luckily most, if not all, the dividends in our ETFs today are qualified dividends. In either case, many investors will choose to keep their dividend stocks in tax advantage accounts such as IRAs and keep their growth stocks in their taxable accounts. It is critical for investors to optimize tax efficiency. The more money you lose to taxes, the less money you can keep invested to be compounded to make you more money. Another thing to consider, if you are focusing only on dividend stocks, you may end up lacking some diversification because some sectors tend to pay more dividends than others. Utilities, energy, telecommunications, consumer staples, and real estate tend to pay the most dividends. Only 40% of the market pays dividend, so you might end up missing out on high-growth tech companies such as Amazon, Tesla, and Facebook that choose to not pay a dividend and instead reinvest back into the growth of the business. And the tech sector has just been so strong over the past 10 years. Additionally, small caps typically do not pay dividends, so you may end up not being diversified across market cap either. And over time, small caps tend to outperform large caps. So as we look at our ETFs, diversification across sectors and market cap can certainly be a plus. Alright, it's finally time to introduce the ETFs. First, we have the US Dividend Equity ETF, SCHD from Charles Schwab. This ETF tracks the Dow Jones US 100 Index, which is designed to measure the performance of high dividend yielding stocks issued by US companies that have a record of consistently paying dividends and are selected for fundamental strength relative to their peers based on financial ratios. Next, we have the High Dividend Yield ETF VYM by Vanguard. This ETF tracks the performance of the FTSE High Dividend Yield Index, which consists of companies that pay dividends that are generally higher than average. Next, we have the Dividend Appreciation ETF VIG, also by Vanguard. This ETF tracks the performance of the NASDAQ US Dividend Achievers Select Index. This is different from VYM in that it consists of companies that have a record of consistently increasing dividends over time. So not just high dividends, but increasing dividends. Dividend growth companies tend to be more stable and less volatile and have strong profitability. Like we mentioned earlier, a high dividend yield can actually be a signal of an unstable company. Last, we have the iShares Core High Dividend ETF by BlackRock. This ETF tracks the Morningstar Dividend Yield Focus Index. It will invest 90% in this index and 10% in certain futures, options, and swap contracts, cash and cash equivalents. This ETF is composed of qualified income-paying U.S. securities that are screened for superior company quality and financial health as determined by Morningstar's proprietary index methodology. Let's get the dividend yield out of the way first because that's the whole point of the video. If a dividend ETF pays a 2% dividend, you have $100,000 invested. You could expect to receive $2,000 in dividends over the year. We have a 30-day SEC yield, which shows the dividend over the last 30 days, the most current dividend. We also have the trailing 12-month dividend yield, which shows the average yield over the last 12 months. One provides a current snapshot and the other gives you an idea of how it has been over time. Comparing and contrasting the two can give you an idea as to where the yield has been and possibly where it's going. Looking at trailing 12-month yield, we have 2.87 for SCHD, 2.78 for VYM, 1.51 for VIG, and 3.57 for HDV. So that would make HDV the winner on yield. However, as we mentioned earlier, you can't just look at the dividend. There are many other factors to consider when choosing a stock or ETF. Let's take a look at portfolio composition. We'll skip regional exposure as these are all US equities. Actually, VYM has a 2% European exposure, but whatever. Looking at market cap, all these are heavy on large caps, with HDV having the most large cap exposure at 90%. The other three are hovering around 80% large cap. Large cap stocks are generally seen as more stable and transparent with well-established revenue and earnings. They also tend to be the biggest dividend payers. Moving on to the fun stuff, let's summarize the sector exposure. HDV has a notably higher exposure to energy than the others. It's 18% energy. Energy is absent from VIG and very low in SCHD. SCHD and VIG have the highest exposure to tech at 20% for those that love tech. Again, the tech sector tends to favor growth over dividend payouts. SCHD and VYM have the highest exposure to financials at 20%. HDV has notably the lowest exposure to financials. Decisions can be made based on which sector you like the most or least. Let's look at industry exposure, but I won't read everything. Again, VYM is overweight on banks. ESG investors should be careful with HDV. It's almost 20% oil and gas and also 5% tobacco stocks. I'm willing to say that SCHD and VIG may be the most well-rounded across industries, with maybe a slight edge to VIG. Let's take a look at top holdings. Diversification can come from a number of holdings, as well as a variety in region, market cap, sector, and industry, as well as a mix of growth and value, but we're not talking about growth today. VYM has the most holdings at 400, and the lowest weight in the top 10 names. HDV has the lowest number of holdings at 80, and the highest percentage in the top 10 names. HDV may be the least diversified ETF on this list, but some investors might value the style of concentration that it has. We see names like Pfizer, Coke, and Pepsi in SCHD. We see JP Morgan, J&J, and Bank of America in VYM. We see names like Microsoft, Walmart, Visa, and VIG. we see Exxon and Chevron and HDV. It seems like HDV chases high dividends the most aggressively. Again, VIG focuses more on companies that have consistently grown their dividends as opposed to just high dividend payers. You could potentially expect more capital appreciation from this strategy. VYM simply has a large basket of high dividend payers, and SCHD focuses on high dividend payers, but also with an emphasis on quality. Let's take a look at cost, and first with that, expense ratios, the annual percentage that we have to pay for management. All these ETFs charge 6 basis points, except for the greedy savages that manage HDV that charge 8 basis points. So I'm obviously joking here. These are all very good expense ratios. No surprise to me because I picked these ETFs because they're all popular and cheap. So on a $10,000 investment in SCHD, VYM, and VIG, they would all cost you $6 a year, and HDV would cost you $8. People underestimate how important it is to keep your costs low. Seemingly small differences in costs can add up to huge differences over time when you factor in the power of compound interest and the lack of when you lose money to fees. Let's take a look at spread costs. Spread is the measure of liquidity and the cost of trading shares. Essentially the difference between the lowest ask price and the highest bid price. The lower the spread is, the lower the cost is to trade. Typically the larger a fund is and the larger the trading volume, the lower the spread. All these ETFs are massive in terms of assets under management. We're talking about tens of billions of dollars each. HDV is the baby in the room and still has $7 billion. Also, as mentioned earlier, these are mostly large cap ETFs. Large caps tend to be very liquid because of the increased amount of buyers and sellers, so spread costs are almost non-existent for all of these, 0.01% for all of them. A more interesting cost metric may be tracking difference. Tracking difference shows how a product's performance compares with that of its benchmark over a stated period of time. It's a good report card for how well a manager is doing. It can depend on factors such as expense ratio, rebalancing costs, sampling, cash drag, security lending, and rebalancing timing. Given that fees are included, tracking difference is typically negative. The median 12-month tracking difference for each is as follows. Minus 0.14% for SCHD, minus 0.02% for VYM, minus 0.16 for VIG, and minus 0.08 for HDV. So we give the tracking difference win to VYM. Usually Vanguard is good with this one, however VYM tracked a little bit better than VIG. But none of these are bad tracking differences. Next, let's take a look at performance, because dividend yield doesn't do you much good if the capital appreciation is terrible. Over 3 years, SCHD and VIG are the winners with an average return of 18 and 17%. VYM is down around 10% and HDV is lacking at 7%. Looking at average returns over 5 years, SCHD and VIG are roughly tied at 16%, 11% for VYM and 7% for HDV. I'm tempted to call it a tie between SCHD and VIG, but the 1 year return of SCHD is impressive, 44%. So I'll use it as a tiebreaker and give the performance win to SCHD. However, investors love to look at performance. We should also consider how much risk we are taking to get such performance, aka risk-adjusted returns. Taking risk can be great in a risk-on environment, but when the tide turns and goes back out, you find out who is swimming without a bathing suit on. To analyze risk and return, we can look at Sharpe ratio. The Sharpe ratio adjusts a portfolio's past performance or the expected future performance for the excess risk that was taken by the investor. A high Sharpe ratio is good when compared to similar portfolios or funds with lower returns. So we see that SCHD and VIG have the best Sharpe ratios and HDV has the lowest. This is visually represented by the graph. HDV shows a similar level of risk to SCHD, but with much lower returns. VIG is plotted as having similar returns to SCHD, but with lower risk. So we can give the risk-adjusted return win to VIG, with SCHD in second place. Lastly, let's look at Analyst Ratings. FactSet was pretty easy to please here. All these ETFs got an A rating from FactSet. Morningstar is a bit more interesting. SCHD got 5 stars, VYM 4, VIG got 3, and HDV got 2 stars. So we can give the analyst rating win to SCHD. So what are my thoughts? This is going to make me very unpopular, but I am personally not a dividend investor, and I don't own any of these ETFs. So please avoid smashing the dislike button and cyberbullying me in the comments over this. Instead, just leave a comment below on why dividends are the best. I know that conventional wisdom tells us to own the broad market as opposed to trying to pick and choose between growth and value stocks. But I've decided to lean a bit heavier on growth stocks while I'm younger and can tolerate a bit more risk, with the hope of being rewarded with more capital appreciation. As I get closer to retirement, transition more to the stable income-producing dividend stocks to live off in retirement. I don't need or want the dividend payouts now. I personally would rather the companies keep that money and reinvest back into the innovative technology to expand and grow their business. It's hard to not lean heavier on growth with how much growth has outperformed value over the past decade, but obviously this is no guarantee in the future. So I'm no dividend hater. At the end of the day, it comes down to the individual risk tolerance of the investor and which style of investing they see more value in. I personally tend to do the best with my highest conviction investments because I see the most value in them, and therefore I don't hesitate to buy the dip when I see blood in the market. So while I'm not a fan of chasing high dividends, I will say that the dividend growth strategy is interesting. This is again companies that steadily increase their dividend over time. This can be an indicator to identify strong, stable, successful companies with potentially better value, quality, and lower volatility. This is the strategy of VIG. So for that reason, if I had to buy one of these ETFs, it would be VIG. But again, VIG doesn't pay a dividend much higher than the broad market. But hey, you asked a growth investor. I would probably put SCHD in a close second and VYM in third place. So all in all, I would just caution about chasing dividends that are too high. Never sacrifice quality for a high dividend. I don't care if I'm looking at a growth company or a value company. It has to be quality if I'm going to invest. I don't want to throw shade, but if I have to throw some shade, I throw it at HDV. There's just too much oil and gas in there for my liking. ESG investors avoid this area for ethical reasons. The energy sector has been rough for a little while now, and I don't exactly see the world moving in a direction that would indicate a big long-term comeback. So I put my money elsewhere. But what do I know? But anyways, if you found any of this helpful, consider hitting the like button and subscribe for more content like this. Also consider checking out the links down below. Currently down there you can get 2 free stocks with Webull, potentially valued up to $2,300, $30 in M1 Finance, a free stock with Robinhood, potentially valued up to $225, and up to $250 with BlockFi, where you can earn interest on your crypto. However, these promos do change over time. As always, this is not financial advice, just for entertainment purposes only. Thanks, and I'll see you in the next video.